From our studios in Las Vegas, this is Stress-Free Finance with Anthony DeLuca.
Welcome to Stress-Free Finance. I'm attorney Anthony DeLuca. So what is this show about? Well, I can tell you right from the beginning what it's not about. It's not here to sell you some sort of product. We're not going to try to sell you on a DVD set or a 12-step program on how to become a millionaire. And although the show does have the word finance in its title, I'm not going to bore you with mundane financial statistics and generic financial advice. The show's far more than that. We're going to discuss politics and politicians and how they're destroying our country and your future. We're going to discuss how their decisions have placed America on a path to no longer being the greatest economic superpower on the planet. We're going to discuss the lobbyists and the relationships they have with the politicians and how this unethical union impacts your life. We're going to discuss corporate America, or should I say the new corporate America, these too big to fail institutions, and how they're hell-bent on making profits at the expense of you, your family, and your future. In future shows, we'll have guests from the political, economic, and money realms who will come in to discuss the global scene, national politics, and the current state of the economy, and how these issues impact your life, and what you can do to prepare for what's going to be a long and devastating economic downturn. This is despite all the rosy depictions by the economists and financial pundits and the Wall Street gurus who keep talking about an economic recovery. You see, these people don't sit down with everyday Americans. I've sat down with tens of thousands of everyday Americans and discussed their finances in great detail. I'll give you the inside scoop on what really is going on with this recovery and what you need to do to prepare yourself for your financial future. When we think about slavery and indentured servitude, we get these horrible images of these horrifying historical events. And of course, they truly are tragic. But if you really think about it, in the modern world, most people, and I do mean most people, truly are slaves to corporate America, the banking industry, and the mortgage industry. They wake up every morning and they go to work only to pay interest on debts to these institutions. We've become a debtor nation in a less brutal form of modern-day slavery. But you don't need to take my word for it. Just look at the data. Over the past decade, more people have declared personal bankruptcy than actually graduated from college. We spend more money on jewelry and watches and all these things we don't need than we spend on higher education. During the 1990s, credit card debts tripled. In the past decade since the 90s, the number of credit card recipients and people holding credit cards and keeping credit card balances has increased even further. Ironically, over the past decades, the more that incomes rise, the less we as Americans save. We currently have a savings rate near zero. Even socialist, communist nations like China have a savings rate over 20%. And we as Americans in our capitalist system, we have a savings rate that hovers near zero. Now recently, we've had a little bit more in the way of savings. And why? Because there's been so many home foreclosures. And since people aren't paying their mortgages, it actually shows that there's some savings in their savings account. But that's just a manipulation of statistical data. It just shows that they have money in their bank accounts when the reality is that it's because their homes are foreclosing. Not exactly a rosy picture to paint. Now, more than once I've mentioned that we as Americans live paycheck to paycheck. What does this really mean? I mean, what's the scope of it? What is the magnitude? What percentage of Americans really do live paycheck to paycheck? Well, to give you an idea, about 60% of Americans are about 1 month away from financial destruction. What does that mean? That means that if you lose your job, you could pay your bills for about a month. And that applies to 60% of families. Now the next tier, they can make it for a whopping 2 months before they're in financial trouble, before they have to go try to find some family members to bail them out. I mean, this isn't the American dream, folks. That is what paycheck to paycheck really means. It means you have nothing in the way of financial reserves. Everything you have, despite the fact that we have bigger homes and nicer cars and we wear nicer clothes and all these creature comforts that we didn't have back in the 60s that we have today, we don't own any of it. The bank does. The credit card industry does. The mortgage industry owns all these things. You have nothing in the way of equity. So this is what we're talking about, living paycheck to paycheck. You're just that far away from having the whole house of cards fall out from beneath you. Now, what's the other impact of living paycheck to paycheck? Well, let's take a look at the divorce rates. I mean, they're hovering near an all-time high. More than half of marriages end in divorce. Now, I'm not saying there's not justifications why people get divorced, but the number one reason why people get divorced is because of money. Financial issues. You know, they fight over making the mortgage payment. They fight over who made the decision to buy this big house. We didn't need to buy a 4,000 square foot house. We could have bought a 2,000 square foot house. Anyway you slice it, it just comes down to couples fight over money. It is the number one issue contributing to an absolutely outrageous divorce rate. And we don't have to get into all the details of what the impact is on children and on the moral fabric of our society and how it's impacted the way our children are raised and the influences that are bestowed upon them. I mean, the point's very simple. Money is a problem, and the problem stems from the fact that we live beyond our means. Now, let's take a look at the fact that over the past several decades, we've made more money than before. We've had more than we've ever had in the history of our country. People have more today. And the ironic thing about it is that depression levels have gone up tenfold since the 1960s. Think about that. I mean, what is the subtle irony there? We have a society where over the past 4 or 5 decades, we make more money, we have 2 cars instead of 1 car, we take more vacations, we have all these extra comforts, but depression levels have gone up tenfold. And it's even more disturbing when you get into the younger people, the teenagers. Depression levels among teenagers have skyrocketed. At the end of the day, folks, you have to make a decision that money's not the most important goal, and we have to get back to living simpler lives where we focus on what's really most important in life. My intention is to take a real-world approach to finance. No BS. You're not going to hear on this show anything about all the generic advice that's been handed out over the years from the people on Wall Street or your real estate agent. I always love some of this advice. For example, let's take Wall Street. One of the greatest statistics they always use is, well, if you invest on the market for the long term, you're going to get an 11% return. And it's just absolute nonsense. It's just manipulated statistics. Look at the Dow 30. The Dow 30, or the Dow Jones Industrial Average, it consists of 30 stocks. But what happens when a stock in the Dow 30 underperforms? They kick it out and they replace it with a better stock. So it's kind of like a Major League Baseball player saying that he has a 650 batting average, but he doesn't really calculate in his pop flies or his ground outs. It doesn't make any sense. Obviously, you take all the losers and throw them out, you're going to have a much higher average than you would normally have. So if you were to go back 30 years and take all of the Dow Jones stocks that existed at that time and figure out where the Dow Jones would be today if those same 30 stocks were included, it wouldn't be at 11,500 or whatever it is happens to be today. It'd be nowhere near there. It's just manipulated statistics. And who's it spread around by? It's spread around by the people who have the most to gain from it. The people on Wall Street, your mutual fund managers. You know, I wonder how many of your mutual fund managers or these people, these stockbrokers and traders who are getting you into their office and telling you they've got the best investment in the history of finance, I wonder if they actually buy into any of the same stocks they're selling you. Stock market is nothing more than a casino, and it's a really big gamble to be in. I don't have any money in the stock market. I will never have any money in the stock market. Look at all the people in the last 5 years who wanted to retire. And the stock market plunged down to 6,000, wiped out half of their total retirement investment. You see, when the stock market falls like it did, and it drops by 50%, it dropped from 11,000 something to 6,000 something. Or if you look back a little further to around 2000, it dropped from a high of about 14,500 down to 6,500. Well, in order for something to go from 14,500 to, let's say, half of that, 7,000 and some change, it's a 50% drop. Now, to go from that 7,500 back up to that 14,000 something, it's a 100% gain. It's not the same. And if you want to retire, you shouldn't be gambling on when exactly the stock market's going to hit its peak. Because at the time you retire, like many people are right now, it's not at its peak. You know, right now you listen to the pundits on Wall Street. What are they saying? There's a bull market because the market's at 11,500. Well, that's interesting because if you look back a decade, the stock market was at 14,000 and some change. So if it's at 11,000 now, how are we in a bull market? In Japan, when they had no growth in the stock market, they called it the lost decade in stocks. Here in the United States, we call it a bull market. It's not a bull market. It's just a continued downward bear market. When the market gets back above 14,000 and keeps going, then come talk to me. Actually, when you do, I'll just call it a bubble then. So be careful about where you're getting your advice from. Okay, stick to things that are extremely conservative because the stock market is not one of them. And many people have their entire 401ks and all their investments that are locked into these high-risk, casino-like mutual fund investments. Let's look at another side of it, real estate. Now, many people bought into the housing market in the last couple of years, in the last 5 years for that matter. And many of these people were encouraged by real estate agents to buy the absolute most they could possibly buy for their money. And one thing I can guarantee you is that when they sat down with their real estate agent, the real estate agent only looked at how big of a loan could their client qualify for and how big of a house could they get for their money. I guarantee you there's a very, very small percentage, if any, of the real estate agents out there actually sat down and said, well, let's see if you can really afford this mortgage. They had these 3-year ARMs and 5-year ARMs, which on paper let people who weren't real knowledgeable about finance believe that they could pay for these loans. Hey, it's a 3 to 5 year ARM. In a 5-year ARM, I can make this payment of $1,200. Yeah, it jumps up to $2,500, but the real estate agents and the brokers, they told them, don't worry, the party's going to go on forever. In 5 years, you just refinance into something better, into a more permanent loan. Well, obviously that didn't happen. The bottom line is you have to look out for yourself because you can't expect your real estate agent, you can't expect your stockbroker, or any of these people who have fundamental vested interest in the outcome to make the best decision for you. Like I said, no real estate agent sat down with you and said, how much do you spend on your food? How much is your car payment? What do you spend on gas? How much is your children's education? What do you spend on insurance? They didn't ask these questions because the overwhelming majority of them didn't care. They wanted to sell you a house. So you have to start looking out for yourselves, folks, because you certainly can't expect the politicians to do so. Politicians, they drove their line right in the sand back in 2008. Everyone remembers the banking bailout, don't you? 2008, when everything started crashing, market went down to around 6,500, and there was this massive global panic. What did the politicians do? They took a 2-page piece of paper and they turned it into a $700 billion bailout, which they gave to the very banks that created the problems, while they left America holding the bag. So again, folks, don't expect your politicians to bail you out. Don't expect the people in the financial industry to bail you out. Don't expect the real estate people to bail you out. All these entities have their own vested interests. And it's not to say that every single one of them is a bad person and every single one of them saw this coming and planned to screw you over, basically. But it's just to say that only you care as much about your family, not them. I can't have a discussion about entities with a vested interest without discussing the mortgage industry and the banking industry. And obviously that leads us into the topic of real estate, particularly here in Nevada. It's one of the most important topics that people have on their mind is the homes they purchased over the last 5 or 6 years or so. What always comes up in these discussions is the topic of loan modifications. Now, loan modifications, what are loan modifications? Basically, it's a modification of the terms of your loan for a specified period of time. Normally, it's a reduction in the amount you pay for a 3 to 5 year period. So they take your loan payment and they reduce it for about 5 years, and then it jumps up or it might step up in terms of the interest rate. Now, it's funny, I keep thinking, where did I hear that before? When was it that I heard about this? low interest rates for 5 years and then have it step up to a higher payment. Oh, that's right. They called it a 3, a 5, and a 7-year ARM just around 3, 5, and 7 years ago. And that's exactly what got us into the problems we have today. So the banking industry, being as crafty as they are, what they did was they took this neat little present called a 3, 5, and 7-year ARM, and they opened it and they regifted it to the American public. And this time they called it a loan modification. But it's the same thing. You're going to pay a smaller rate for a set period of time, and then at the end of that set period of time, your payment's going to jump up to an amount you can't afford. So what's really the point of it? So you've got a $2,000 mortgage, and they drop your payment to $1,500 for 5 years. And then they jump it back up to $2,000 again. So at the end of the 5-year period, you're just as more or less screwed as when you started. I mean, the purpose of engaging in any sort of financial rehabilitation, of trying to straighten out your financial picture, it has to have a long-term perspective. Okay, if your house is worth $150,000 and you owe $300,000 on it, what's going to happen at the end of the 5-year period? Or do you really think that your house is going to go from the $150,000 it's worth and jump up to $300,000 plus? So at the end of this 5-year loan modification, you can go ahead and finance your way out of it or sell it? Absolutely not. Traditional appreciation on homes is 3 to 5%. What you saw happen over the past 5 years, this is an absolute complete anomaly. You will probably never see it in your lifetime. Hopefully you will never see it in your lifetime. Okay, this isn't the stock market where you buy ABC stock and it shoots up to $10 and then drops back down to 5, and 3 months later it's back up to 10 again. Absolutely not. This is the housing market. 3 to 5% appreciation on a house that's worth $150,000. For that to get back up to the $300,000 plus that you owe, it's going to take a decade or 2 decades to get there. And it's just not a good investment. It's never a good investment. So despite the fact that there's a 90% plus chance that your loan modification will be denied, and that is that is statistics straight from the government, it really doesn't matter. So everybody's heard the horror stories. I mean, it's not like this is something new. Loan mods have been going on for a while now, and everybody's had a friend or a coworker or a colleague who they've tried the loan modification. The banks claim that they lost their documents or that they told them, which I think this is just bizarre. They say, hey, we can't help you because you're current on your mortgage, so fall 3 months behind. And following their advice, they fall 3 months behind, which of course the bank charges them late fees, and then attorney fees, and then foreclosure fees, and then they tell them to file a loan modification. And they file the loan modification, they drag it out for 6 months or a year, and then they foreclose on the people's property. It's just ridiculous. And the loan modifications, at its very core, is just a joke, because even if you are part of that 10% or less, probably less, to actually get a permanent loan modification, so what? What did you actually acquire? I don't care if they drop your interest rates to 0%. What did you really accomplish? Now you've got a home that you owe $300,000 at 0% interest, where it's only worth $150,000. I mean, would you ever go into a car lot and say, hey, I really like that car over there. What's the sticker price? $15,000? Wow, that's great. You know what? I'd like to pay $30,000 for it. Look, I don't care how they modify your loan. If they're not going to cut the principal dramatically, so in the case we have here, where you owe $300,000, it's worth $150,000, unless they're going to cut your principal down to $150,000, what it's worth, it's just never, ever going to be a good investment. And maybe your best bet is just to walk away. If you walk away from the home, maybe it'll take you 4 or 5 years to get another loan. You have to save up a bigger down payment because the rates are much harder to get. The banking industry is, despite all the money they've been given in the bailout, the restrictions and their loan terms are much more difficult to adhere to. So they might ask you for 20% down. But you know what? You walk away from that $2,000 mortgage payment, you rent for a few years at a place that's probably bigger for hundreds of dollars less, and then you buy 4 or 5 years down the road, you buy something that's worth what you actually owe on it. Okay? So, when you think about a loan modification, the only time that you should even consider it is, there's circumstances where a person's 80 years old and they modify the loan terms, and you know what, they just don't care, because at the end of the loan mod terms, well, I think we all know where we're going with this. But if you're a young person and you're not planning on staying in that house for the next 20 years, you're not planning on living in that neighborhood, you don't love your home, then there's just no reason to do the loan modification. What a lot of people don't know about me is that aside from having a law degree, I actually have a master's in psychology from the University of Pennsylvania. More specifically, I have a master's of applied positive psychology. Because it's an Ivy League institution, they were able to recruit some of the top psychologists in the country. They brought these people in and they began training students and developing studies, scientific studies on global happiness. What it is that makes people happy, not only here in the United States, but around the world. Interestingly, among the industrialized nations, the United States didn't fare too well. But what we did gather from these global happiness studies is that the cliche that money does not make you happy is really not a cliche at all. It's absolutely true. Once you get above the poverty level, once you have a roof over your head, you have food on the table, you have clothes on your back, incremental increases in your income or your lifestyle really don't translate into any greater levels of happiness experienced by the individuals. So if you lived in a 2,000 square foot house and you got a raise at your job from 40,000 to 50,000, then you bought a 3,000 square foot house, you wouldn't experience any greater increase in your overall happiness levels. Maybe for a month or two, you might experience some spike in the level of happiness you enjoy from your bigger home. But we all experience what's known as habituation. And habituation means that we as human beings will get used to any set of circumstances that you put us into. And eventually we'll cease to satisfy ourselves or have any enjoyment from it. So in other words, you'll buy that 3,000 square foot house, and pretty soon you'll be looking around and saying, yeah, this is nice. But you know what would really be nice? If I had a 4,000 square foot house. So once I get the 4,000 square foot house, then I'll be happy. And just an endless roller coaster. And at the end of the day, what that leads us to is the rat race. And it leads us to this endless pursuit of material possession that doesn't really contribute to any meaningful happiness in our lives. In future shows, we're going to get more into the specifics of a plan of action. Now, we're not going to focus on teaching you how to make more money. There's plenty of gimmicky books out there and CD programs that will teach you how to be a millionaire. What we're really going to focus on is something that's more real, more tangible, something that you can actually accomplish. It can accomplish quickly, and that is eliminating your debt, reducing your expenses, simplifying your life. And the purpose of this is to make sure that you can sustain your lifestyle and contribute your time to more meaningful purposes so that you can spend more time with your family, you can spend more time building relationships, and so we can eliminate many of the stresses associated with money. Stresses to your health, stresses to your relationships, stresses to your peace of mind, and stresses to your overall happiness. Because that's the ultimate goal in life. It's not to make $1 million. It's to live a life in which you can enjoy yourself, enjoy the time with the loved ones in your life, and that you can overall try to be as happy as you can be. Thanks for tuning into the show. If you have any questions or comments, or there's a topic that maybe you'd like to be discussed on a future episode, go to the website on the screen, DeLuca-associates.com, and check out our blog. Thanks again for tuning in. Have a great week, fight the good fight, and don't let corporate America get the best of you. I'm Anthony DeLuca. We'll see you next time. The bankruptcy code is complex, and experience means everything. Over the last decade, DeLuca & Associates consulted with tens of thousands of Las Vegans experiencing financial difficulty. We're not some jack-of-all-trades law firm that threw in bankruptcy after the recession hit. We're a bankruptcy firm. Our focus is on making this difficult process as simple as possible for you. We obtain the credit reports, we draft all the complicated paperwork. At DeLuca & Associates, your best interests come first. Call us at 252-HOPE.